and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sandeep Asthana, CEO from Patanjali Foods and Limited. Thank you, and over to you, sir.
Thank you very much, and good morning and welcome. Thank you for joining us today for Patanjali Foods Limited's call to discuss the results of Q4 and financial year 24. I'm accompanied by the company's CFO, Mr. Kumar Rajesh, as well as Mr. Priyendu Jha and Mr. Chintan Kotak from the IR team, along with our Investor Relations Advisors, Strategic Growth Advisors team. For your convenience, we have uploaded the results collateral on both the stock exchanges and the company's website. Our initiatives in every area have set a solid foundation for FY24 and are keeping us on track for an even stronger performance in FY25. I'm pleased to announce that we have achieved strong results across multiple financial metrics in the fiscal year 24. Our revenue from operations reached INR 31,721 crores, while our EBITDA stood at INR 1,518 crores, maintaining a healthy EBITDA margin of 4.75% to total income. A strategic adjustment in our business mix led to a fourfold increase in the contribution of food and FMCG segment between FY22 and 24. During the year, we achieved a PAT of INR 765 crores with a margin of 2.39%. As part of our strategic approach, we conduct pilot launches for new products to gauge market viability. Upon receiving positive results and encouraging feedback from these pilot launches, we proceed to introduce the products to broader markets. Notable pilot launches throughout the year have included millet-based digestive biscuits and the Nutrela Max Millet cereal range, branded dry fruits under Nutrela Max Nuts range, and tea. Looking ahead, we have a strong pipeline of diverse products ready to meet the evolving demands of consumers in the upcoming year. The impact of our advertising expenditure is evident, reflected in an increase in volumes. The company is dedicated to further strengthening its brand building efforts. The company's growth is fueled by ongoing product innovation and premiumization across various categories and price points. This allows us to keep pace with consumers' constantly evolving preferences. The recovery of demand in rural India has commenced, and it is steadily gaining momentum. With our extensive reach in hinterland, we are actively working to further stimulate this demand. Transitioning to our strategic updates, we are in the process of shifting our focus to high-margin FMCG business. As part of this strategy, we are evaluating the acquisition of Patanjali Ayurved Limited's HPC portfolio, encompassing hair, skin, dental, and home care products, which includes renowned brands like Dantkanti in the dental care, Saundarya in the skin care, Kesh Kanti in the hair care, and Super Dishwash and Herbal Mosquito Repellent. A committee has been formed to meticulously examine the initial proposal. We are assessing this proposal for its strategic synergy across various facets with the aim of creating long-term value. However, it's premature to comment on the specifics of the deal at this stage. Additionally, we have recently founded two wholly owned subsidiary companies in India, Contemporary Agro Private Limited and Rishi Krishi Farming Private Limited. These subsidiaries are committed to providing extensive training programs for farmers with the goal of improving agricultural practices and promoting sustainable growth. Coming to our quarterly performance, in the edible oil business, in Q4, the edible oil segment recorded 5,588 crores in revenue, making a 1.9% Q-on-Q growth. Out of this, INR 124 crores represents revenue generated from the palm oil plantation business. In Q4 FY24, the volumes increased by 5% to 6 lakh tons, 6.04 lakh metric tons, compared to 6.34 lakh metric tons in Q4 financial year 23. For FY24, Overall, the volumes rose to 24.99 lakh tons, nearly 25 lakh tons, reflecting a growth of 13.1% over financial year 23. This growth in volume was attained through expanded distribution reach and enhanced consumer offerings that we continue to offer. The premium oil segment, including Nutrela oil, is flourishing, witnessing a significant annual growth of 26.2%, reaching 21,275 metric tons, with an additional 20.6% year-on-year growth over Q4, totaling to 5,988 metric tons. This underscores robust consumer demand and Nutrela's effective market presence. Ruchi Gold received the prestigious Best Brand Award in palm oil from the Rabi Seminar and Central Organization for Oil Industry and Trade, highlighting its excellence in the palm oil category. During the fourth quarter, the cash market prices experienced a significant rebound, making a notable recovery from low levels observed in the previous quarters. The edible oil prices demonstrated a sharp upturn in Q4, with palm oil, soya oil, and sun oil prices increasing by 17%, 10%, and 6% respectively, quarter over quarter. The price differential between futures and physical prices indicated a close alignment for palm oil, with both markets moving in tandem, minimizing disparities. However, soya oil exhibited an 11% divergence, primarily attributed to an increase in cash prices. In the oil palm plantation business, the company is advancing its oil palm plantation on a fast-track basis, with over 74,376 hectares under cultivation, involving collaboration with numerous farmers across 12 states in India. As of March 31st, 2024, the share of young plantation, which is under 3 years, stood at approximately 33%, marking a significant increase from around 19% recorded in March 23. Furthermore, the company has established 14 new nurseries during the year, bringing the total nursery count to 40 to support the future expansion of the cultivation area. For this quarter, the oil palm plantation has generated a revenue of 124 crores. Our oil extraction rate was 18.65%, reflecting the efficiency in the FFB processing continues to rank among the best in the industry, aligned with global standards. The oil palm plantation business represents a key avenue for long-term growth for Patanjali Foods, serving as a vital element in national development. It forms an integral part of our national endeavor, and we are committing to nurturing this business to contribute meaningfully to the nation's progress and prosperity. Talking about the food and FMCG segment, in this quarter, the food and FMCG segment achieved revenues of INR 2,704 crores with an EBITDA margin of 9.6%. During the quarter, the food and FMCG segment accounted for approximately 32.57% of total revenues, maintaining consistency with quarter 3 performance at 31.27%. Similarly, on a full year basis, the food and FMCG segment contributed approximately 30% to total revenues, demonstrating an impressive growth of 55%. The company's dedicated focus on expanding the biscuits portfolio has yielded significant results, with new premium biscuit launches, a direct retail reach extended to over 1 million retail outlets, and distribution through various channels. This segment achieved a remarkable growth rate of 22%, surpassing the industry growth of 8% CAGR. The biscuit volumes witnessed a substantial increase, reaching 39,787 metric tons in Q4, compared to 34,614 metric tons in Q4 last year, and 1.64 lakh metric tons in financial year 24, as opposed to 1.31 lakh metric tons. Our flagship biscuit brand Doodh has crossed the 1,000 crore milestone in this financial year. We express our gratitude for the widespread acceptance of our product. Similarly, Nariyal and Crunchy coconut biscuits have received tremendous consumer response and registered double-digit during the quarter on year-on-year basis. Additionally, the recently launched premium biscuit range continued to garner positive traction among consumers. The direct retail reach has expanded to over 1 million outlets, showcasing extensive market penetration. Nutrela soya chunks experienced a notable 7.7% increase in annual sales volume, reaching 27,710 metric tons. Nutraceutical range sales remained consistent with the previous quarter, standing at about 10 crores compared to INR 14 crores in Q3 of last year. We closely monitor market trends and consumer preferences, ensuring our offerings align with the evolving consumer demands. We recently relaunched sports nutrition under Nutrela Sports, establishing separate teams and distribution infrastructure. There has been a significant surge in e-commerce sales of nutraceuticals. In FY24, the company was honored as the Nutraceutical Company of the Year by the India Food Safety and Nutrition Summit. Overall, the nutraceutical segment remains an integral part of the business, and we maintain a positive outlook on its future performance. Patanjali maintains its employee-centric approach and continues to invest in its workforce. During the year, we introduced the PFL Employee Stock Option Plan of 2023. Additionally, for the third consecutive year, the company has been recognized as the Great Place to Work. Offering a glimpse into the industry landscape, the rural demand has surpassed urban demand for the first time in the last 5 quarters, with rural sales growth at 7.6%, surpassing urban growth at 5.7%. This resurgence in consumer activity can be attributed to robust Rabi crop yields, bumper wheat harvest, increased government initiatives such as higher MSP and greater spending on Manrega. The upcoming months show promise for rural segment, supported by factors such as promising monsoon forecasts, potential increase in rural wages and farm incomes, and a broader macroeconomic conditions conducive to growth. The extent of margin enhancement depends on the trajectory of price growth and further easing of input costs for most raw materials, with a favorable outlook as the global inflation is predicted to ease. However, the volatility of crude prices remains a factor requiring close monitoring. Taking a closer look at our financial performance during the quarter, our revenue from operations in Q4 reached INR 8,221 crores, making a YoY growth of 4.43%. The total income recorded stands at INR 8,348 crores. Our EBITDA stood at INR 496 crores, experiencing a significant Q-on-Q growth of 27.23% and a year-on-year growth of 19.37%. This growth can be attributed mainly to the change in our product mix. Our PAT stood at INR 206 crores with a margin of 2.47%, vis-a-vis 2.72% in Q3 of FY24. For FY24, the numbers stack up as follows. For the full financial year, our revenue from operations stood at 31,721 crores, making a stable performance with a modest increase of 0.62% year-on-year. The total income booked at INR 31,961 crores. Our EBITDA was recorded at INR 1518 crores at a margin of 4.75%. Our PAT recorded at INR 765 crores with a margin of 2.39%. We continue to export to over 25 countries with a value amounting to INR 323 crores. Our annual performance reflects the culmination of past strategic initiatives, reshaping our company's revenue mix and profile. This evolution enhances the quality of our profits and introduces higher margin opportunities, ultimately delivering superior returns to our businesses. The floor is now open for Q&A, and we are very happy to answer any of your questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking the question. Ladies and gentlemen, we wait for the moment while the question queue assembles. The first question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
Asthanaji, good morning.
Good morning.
2 questions on the foods portfolio.
Sorry to interrupt you. Your voice is not audible. Hello, Mr. Bharat Shah. Your voice is breaking. I just request you to reconnect yourself, please.
Bharat Bhai, sir, your voice is slightly unclear, so I would request that maybe if you can repeat that question, please.
Yeah. Can you to hear me now?
Lesser, Bharat Bhai, it is breaking.
Okay. Let me join.
Yes, please, sir. Thank you.
Yeah, thank you. The next question is from the line of Abneesh Roy from Nuvama Wealth. Please go ahead.
Yeah, thanks. My first question is on biscuits category. So we have seen the market leader see good revival in volume growth, and at some stage it expects in FY25 double-digit volume growth also to come for it. So wanted to understand, are you seeing broad-based recovery in biscuits industry? And on the raw material for biscuits on wheat, you did allude briefly. So wanted to understand, last 2 years for wheat crop, it has been challenging. So this year, what is your understanding? Because still we are in the midst of the crop collection. How do you see that some level of deflation in wheat crop can happen? YOY?
Yeah, so no, very good question. So two parts. One is that our biscuit performance is actually generally an outlier overall, because the volume increase and the revenue increase that we are seeing is both, of course, adding to the to the bottom line significantly. So, for example, our margin from 9.3% last year, EBITDA margins has moved to 14%. And as a threshold of the distribution that we are seeing, so we are clearly seeing that the distribution base that we continue to expand, it is giving us a huge leg up in terms of building up the sales. And we continue to target aggressively. And while the specific numbers annually, it is difficult to give, but broadly we expect that we will continue to maintain between 16 to 20% growth on the biscuit front on the revenue side. There we are trying to now going for a better superior mix now. So do that already for 1,000 crores. The other biscuits are about 600 crores. We are expecting that Doodh will continue to maintain its trajectory, and the premium end of the biscuits will continue to grow. So we are hoping that our bottom line, EBITDA margin of 14%, we continue to improve, because to be on a certain point, EBITDA continues to kick up way better with the cost structures being safe. Coming back to the industry, I think largely the growth has been fairly subdued for most companies. And just at the industry average was about 8%. But broadly, I'm expecting that the recovery should happen, because the rural demand continues to show some positivity. And so that growth is there. And second is on the urban side, the premium end of the market, basically in digestives and cookies and cream crackers and others, there is an uptick. So I would be positively sort of oriented towards the biscuits as a range for most players. On the part of the commodity prices, I think oil prices have been extremely supportive through the year, barring this last quarter when we saw an uptick, but broadly it is supportive. The wheat prices, the crop has been good. The government, both for the purposes of upcoming sort of ongoing elections that we have, and to control consumer inflation, has taken a very strong grip over the market in terms of controlling in multiple different ways on the stock control orders, on the private trade is not allowed to sort of speculate much, making sure that the actual user using the buffer stocks to sort of continue to maintain in the marketplace. So I'm expecting a reasonably benign sort of price outlook for wheat prices this year. And likewise for sugar as well, both the global prices and the domestic prices being soft. So overall, wheat, the biscuits industry with the three prime ingredients, the oil, the flour, and the sugar, being supportive. So overall, I think this year should be positive for most biscuit companies, and certainly, as I mentioned already, that we are targeting aggressive growth plans. We continue to expand distribution, and virtually every month we are adding between 12 to 15,000 retail outlets, to our expansion. So we are pretty much on course to have an expanded reach on the biscuit business.
Sure. My second question is on the demand side. So we are seeing in Q4 the commentary of FMCG companies is turning positive. And we are seeing also in few categories like oral care, good volume growth coming back, especially in South India. Wanted to understand your sense on demand trends in FY25. Clearly, rural seems behind. But given you are also across many categories, how you see rural versus urban, and is South India leading the recovery currently?
So clearly, two trends are quite visible. That one is that rural from this Q4 onwards looks reasonably stable. I think after a difficult couple of quarters when the demand was subdued, I think Q4 onwards it looks very positive overall. So in general, we are bullish. And if you see between rural and urban, the growth pattern in rural is, the uptick is way better. In terms of the regional-wise, uptick, we are not in per se witnessing anything in particular that southern India is doing better or otherwise. I think the broad-based recovery that we're seeing in the markets, and which is a reflection of the stronger the rural incomes on account of the good crops, the better MSP administration that is happening. So overall, the trend is good. I mean, South is, of course, as always, a little ahead of when the demand upsurge happens. Typically, South tends to demonstrate, better uptake sooner. So that is there, but I don't see any major differences per se between the respective regions.
Sure. And last quick question. So recently, last 1 or 2 months, the group overall has been there in terms of news flow, Supreme Court, and maybe one of the northern states, etc. So how does this impact the brand, given consumer is also reading all those news flow on a daily basis? And second, related question is, ESOP policy is there. So if you could comment how that's helping, how has been the attrition in terms of the middle level management and senior level management, in terms of professionalization, how is the journey?
So Abhish, broadly, two parts. One is that to the sense of, being in the news, yes, it happens. So from Patanjali Foods perspective, the impact has been minimal. So both we've continued to sort of grow on the business, both and across the board on all the food and FMCG segments that I speak about. So for example, if I were to look at from last year's, Q4 of last year versus this year, I mean, our sales have broadly actually gone up substantially. We are up almost 14%, there. And likewise, overall, I feel that the impact is minimal. Having said that, I think, at an individual level, that is being dealt with. And, there's a positivity there. Broadly, I think it should sooner than later be out of, out of everyone's mind. And also, broadly, it has been sort of largely cleared. In terms of, the one particular state that you mentioned, even that is getting addressed, and the matter is under consideration. We're hoping that all that will be behind us soon. On the side of ESOP that you mentioned, so attrition rate in terms of at a junior level, I think if I were to look at the industry trends, so, they're multi-tiered. At the top leadership level, there are 0 resignations. At mid-level, we are pretty much on course. There are not, the percentage of resignations and all that are nothing to sort of even worth mentioning that there's any attrition at all. But at junior level, that attrition rate continues, which is at absolutely the ground level, sort of feet on the street. So there, it's a pretty much standard part where the people, tend to sort of rotate. And we keep addressing that. We continue to work on the various programs, etc., to keep the training the workforce, to work closely, with them, and so that there's nothing adverse at all. In fact, I would say it's compared to the industry, we are more positive on the side of manpower retention.
Sure, thanks. That's helpful. All the best. Thank you.
Thank you. Thank you very much.
Thank you. The next question is from the line of Bharat Shah from Ax Investment Management. Please go ahead.
Yeah, hi. Namaskar, Astanaji. I hope now my voice is clear.
Loud and clear, Bharat Bhai. Thank you. Namaskar.
Okay. Yeah. 2 questions. Starting with the food portfolio. With biscuit is truly coming there. The rate of growth
Sorry,
salience of the
breaking again.
Bharat bhai, I'm really sorry. Your voice is breaking. You were asking about, I think I just heard biscuits part in the overall food portfolio.
Hello.
Yes, Bharat bhai.
Is my voice coming through, or should I rejoin?
No. Right now it is it's coming through, but I just hope it just maintains itself. So please speak, Bharat bhai. I'll just answer that.
Yeah. So I was saying on the biscuits part, what we have done is truly commendable. In a relatively short period, the buoyancy of the turnover, the salience to the customers, number of products.
Bharat bhai, we lost you.
Hello.
Yes, Bharat bhai, now it is better. We lost you in the middle. On the biscuit part, biscuits you've said it. Yes, please.
Now.
Sorry, I'm unable to hear, sir. Yes, please. Thank you. The next question is from the line of Dheeraj Mistry from Ashika Stock Broking. Please go ahead.
Yeah. Congrats on very good set of number for the FMCG business. So, Sanjeev sir, can you split this foods and FMCG turnover between foods, biscuit, neutral and nutraceutical? And which segment particularly has led to this 50% growth during the quarter?
Yeah, sure. So the quarterly revenues, I will just split that for you. It is we did in the Nutrela soya products, we did 125 crores. In the biscuits business, we did 423 crores. In the food business, we did 2,148 crores, and we did 10 crores in nutraceuticals.
Okay. So, what is driving our EBITDA? So we are long time away. So we have been always guiding that this food and FMCG turnover business would be contributing somewhere around 15 to 17% kind of a EBITDA margin, whereas our current clocking rate of 9.5, 9.6% is way below their expectation. How do we look forward that what kind of EBITDA margin is kind of a sustainable EBITDA margin for this segment? And within foods categories also like 62% growth, which particular segment has led to this 62% growth in foods category?
No, it's a valid question, and I would like to just explain the mix of food business. So food, we have two parts. One is the staples part, which is a lower margin category, which comprises of rice and pulses and even partially, the wheat flour, partially, some of the other product categories, typically, which would fall in the staples category. And the rest of it is the higher margin categories like, ghee, our Chyawanprash, honey, medicated juices, etc., which is a fairly large category, and even spices, etc., which is a large category that we work in. So if I were to give you a split of, compared to last year, we had revenue in the food business overall of 3,791 crores, which was 9 months only. But I just, as a percentage part, we should look at. And this comprised of about 811 crores in staples and about 2,980 crores in others. What has happened is that this 2,980 crores has jumped to 4,062 crores on the full year basis. and 811 crores of staples jumped to 3,234 crores. So there was a large scale push towards a lot of staples tended to move faster, where the margin is about 7.5% broadly, and we can go to categories also, each of these categories. So if I were to look at the margin construct, so 82980 crores, we moved to 4,062 crores. Okay, the high margin business. There, last year we made about 24.2% margin. We made this year 17.1% margin, owing to some of the input cost challenges that we had on the supply chain front in certain products, because all of them are largely agriculture products. So there was a higher prices at the input level. So that we saw a decline of about 7% on those products. On the staple side, our margin typically pretty much remained around in the range of 7-8%. So on the 3,234 crores, we made 243 crores margin. So in absolute terms, the margin has moved up from 781 to 937 crores. But on a percentage basis, it is showing a lower reflection versus 20.6% on a consolidated basis of the food. We are seeing 12.8%. I think the mix of our product portfolio, because of the higher staples that move through the system, that has brought down the percentage of margin. But in absolute terms, we have done better. So the plan going forward, and this year we are saying it was basically largely the year, as I mentioned in my brief remarks earlier and to one of the questions, that there is certain subdued demand which was there, seasonality impact, certain other factors had an impact. But broadly, this run rate of 17 to 18%, which we always said should remain. We got a benefit last year, incidentally, on the premium products was also the one-time inventory gain, etc., which came in when the food was transferred, in the second quarter of last year. But broadly, the target longer term is that we should maintain a trajectory of 16 to 18% margin on the food as an overall portfolio, which is including the staples as well. It is just that the configuration of the portfolio, because there is a higher demand for certain products. Many times this may switch, but broadly the target is pretty much clear that 16 to 18% is the growth that we want to maintain in the food business overall.
Got it. And second, on nutraceutical, that we have been relaunching this product, but for the full year basis, it's still below what we have been guiding for. How do we look this category going forward, nutraceutical?
I'll explain that to you. So and we've gone over this question a few times. We started the year, we've actually taken a complete orientation towards the branding of the business entirely. So for example, this year our margin on the business is good as a percentage term, but in absolute terms it's low. So we have done about 100 crores this year, and we've made about 22 crores, so we bid on that, about 22% margin, which is our expectation in line with between 25 and 30%, we should make the margin. The problem, which we encountered, which has taken a little longer than what we anticipated, is that on the nutraceutical side, completely rebrand. For example, our entire sports nutrition, we rebranded. We launched this VMS, vitamins, minerals and supplements, we relaunched. So there's a lot of adjustment to the marketing contours in the way we have gone about it. We are positive. So this year we have done 100 crores last year in FY24. This year we should grow. Definitely the target is we should grow upwards of 50% growth rate. We want to have a nutraceutical, and thereafter continue to stabilize at a margin profile of 25 to 30%, and have a business which is growing quite rapidly. So I would not be at all negative towards nutraceuticals. If at all, I'm now much more positive that from this fiscal onwards, you will see a positive run on the nutraceutical business for us.
Got it. And so second question on palm oil plantation, what would be the annualized turnover and EBITDA margin what we did on the palm oil plantation?
So palm oil plantation, last year we did 950 crores, and I'll just take a minute more, and the year before that we did 1161 crores. So the absolute margin, what we had in FY23 was 215 crores, which has actually come down to 156 crores. So the reason, and the EBITDA margin was about 17% this year, and compared to about 18.5% last year. So I'll explain the reason for this. So our yields are going up constantly because the drop in overall palm oil prices of 10%. So the margin, the way this business is structured is that the oil FFB prices that we pay for as a raw material are entirely linked to the international prices, and the end prices are also linked to the domestic oil prices. So if the price of if this prices were to double up, let's say if it goes up by 100%, our margin would go up to almost 350 crores, 320 crores. If the margin, if it goes, like if the prices were to go still further down, we would lose margin on that. So it is dependent entirely on the oil prices which are ruling internationally. But the progress on palm oil is very good. Next year, we are quite, with all the work that has happened in the last 18 months, we are quite hopeful that next year we will have a plantation which will add additional, anywhere between 40 to 50,000 hectares to the plantation. Our 0 to 3 years plantation, which is about 1/3 of the portfolio now, should start yielding. The initial sort of revenue should start kicking in from end of next year. So we are very optimistic that this business range of 16 to 18% as an EBITDA margin business, it's like an annuity business. It will consistently give to the company, and it is going to increase.
Yes. So, sir, regarding this question only extension to...
I'm sorry to interrupt, sir. Please, can you just return to the question queue?
Sure.
Thank you. A reminder to all participants, you may press star and one to ask questions. I repeat, you may press star and one to ask questions. The next question is from the line of Shirish Pardesi from Centrum Broking. Please go ahead.
Hi, good morning, Asthanaji. Thanks for the opportunity. I am on slide 7. So I'm just basically looking 22,384 crore what we did for edible oil. Broadly, if you can give the split between Mahakosh. Obviously, Mahakosh is doing better, and we have now have MS Dhoni also on the brand. So maybe if you can specifically give the split of various edible oil segments.
So the standard split that we have between palm, soya, and sun is that 70% of our product mix is typically palm oil.
Yeah.
About 25% is soya, and about balance would be comprising of the sunflower. So typically in the split of 25 lakh tons, what we did in the last year, we would have done close to 16 lakh tons is palm oil. Close to about 4.5 lakh tons would be soya oil, and the balance would be sun and the other oil species, because we do other oils also. Mustard oil is quite a large portfolio for us. So that is how this split would be there.
And specifically, what is the growth we would have had on Mahakosh?
So Mahakosh, as I mentioned in my call also, it's the largest selling palm oil brand in the country. So the growth we have seen, so this year so palm oil has two sides to it. One is what we do institutional business, and second is what we do on the branded side. To your question of Mahakosh, our growth rates are typically between 7 to 8%.
But that is on the branded side, I'm asking.
On the branded side, I'm saying.
Okay. And typically, you mentioned that the prices in Q4 is firmed up for palm about 17%, soya on 10%, and sun is 6%. What's your this quarter, or maybe if you can give medium-term outlook, is this prices will remain steady or move upward?
So broadly, see the two things, the trends are, global prices are obviously a little volatile because we are getting into now the weather markets in the US. But the expectation is the palm oil longer term view is that palm oil prices should tend to firm up. But short term view is that now the peak harvest time is coming in both Malaysia and Indonesia. The peak harvest is starting in India. So in general, our view is that market should be more easy. The prices should be benign, and market should tend to head lower. They've already declined, partially compared to the soya prices, while on a standalone basis they went up. But I think broadly we're expecting a softer sort of market going forward for the next 2 months.
Okay. The reason why I'm asking is because generally you give the volume growth for edible oil. So what is the quarter four and full year growth we would have?
So I mentioned that we've done 13.1% has been the volume growth in edible oils.
Okay.
And we've grown to 25 lakh tons in volume terms. And I mean, we overall our absolute volumes are 25 lakh tons in the edible oil segment overall.
Okay. And just last question, when you say your gross margins are higher on overall biscuit portfolio, will Doodh will have a better margin as the company average overall in biscuits, or will be similar?
No, Doodh will tend to have lower margin, but Doodh, because of the absolute size of the scale of the business, so biscuits typically run on the basic equation that beyond a particular point, the gross margins, it's the overall margin, EBITDA margins tend to sort of get better. So Doodh is contributing, overall because of the sheer size of the portfolio that we have. Contributes to the positive margin, but if I were to look the comparison between Doodh and the non 1,000 crores versus 600 crores, the margin would be equally split.
Okay. My last question on the international part. Can you share what are the plans for FY25 and which category, which countries?
So this is, one part. There's a very heightened focus on the international exports, and these are not just the commodity exports. Commodity exports are declining actually. So both our earlier sort of business of soya meal exports and others has continued to trend lower. Our big focus is right now on the branded business, also the food additive business, so like food application businesses. So I'll start with the food additive side, and then I'll go to the branded side. So working quite aggressively on things like lecithin, the soya flour, soya sort of grits, etc., which have got multiple different food applications in different industries, where the value sort of realization is better. The application, the more we make it superior, the better is the realization, and the better is the profit margin for us. On the branded side, the broad business is that we're working on. Both in terms of expanding our reach in the foods portfolio, as well as, while that is not our remit right now, but at some point of time, when we're able to go towards the non-food side, we would be expanding it quite rapidly because there's a large sort of demand base which is there. So we've got our 4 distributors in the US. We're expanding. So North American markets are a large part of our target. We're building up bases in Europe. Australia, we've got a dedicated distribution base that has been set up now, and likewise in the Middle East. So for these specific regions where the demand side is high. So overall, broadly, this the number of countries, the target is that we should go in fullness of time to 60 countries. This portfolio of 323 odd crores that we did should continue to expand at 20% year on year. And we'll continue to drive exports in a more aggressive way, because there is a big demand pool that we see, and which is today underserviced and which is getting serviced through grey channels. So if you were to look at the Patanjali products reaching the shelves, a lot of them would be reaching through market channels other than what we're directly putting it. So that has been put in place. There's a team which has come on board. There's an aggressive push in the way it is being driven. So we're pretty positive that this will do well in this year also. We should achieve 15 to 20% growth on the export side.
Sure. Thank you and all the best.
Thank you so much.
Thank you. The next question is from the line of Bharat Shah from ARX Investment Managers. Please go ahead.
Is the voice clear now, or should I give you?
Bharat, it is clear now. Sorry about this.
No, no worry. 2 or 3 questions on the foods part first. As I was saying, what we've done on biscuits is truly remarkable in my opinion. The rate of growth, number of products, gaining the market share, and the quality of products all score very well in each aspect. But on the other part of the foods portfolio, how do we see the growth? If we break it up into those staples, the low margin business, and higher margin ghee and other businesses, how do we visualize or see success of what has happened on biscuits on these other part? Mainly not staple, but a higher margin food business. What kind of plans are of food, and what kind of growth do we visualize there?
So, Bharat, to answer your question in simple terms, there is two parts, sort of on percentage terms, brought the margin down from 24% to 17%. We had there is some change that we are seeing and happened in the medicated juices, where the prices, the sales this year declined. And part of that impact we saw on honey. So these were two products where we saw decline. But overall, in terms of the ghee, for example, that which is more than 1,500 crores, which has grown consistently and continues to occupy very premium end position. If we were to look at, the Chyawanprash, which is continuing to grow at a healthy rate, the medicated juices we are bringing back to the fore. Spices have grown quite a bit. So broadly, I would say that the margins are now coming back to very on the premium products I'm talking now. Is margins are coming back to more steady state, which we've already always said that they will be between 16 and 18%. This year we did about 17.1% on a full year basis. So EBITDA margins, and this we expect that once the revenue growth is there, we are seeing typically between 8 to 10% of growth. The margin we will project that should remain between 16 to 18%. The issue is at staples, as rightly what we're seeing, that the more it gets pushed through the food system, on percentage basis, it tends to show lower margin. Even though absolute terms we've actually gone up, because this time we had the benefit of the full year numbers compared to 9 months last year on the food side. So 937 crores that we got. I would say that we continue pushing and innovating. We launched, the new campaigns on Chyawanprash, on honey and spices. We launched, on the, so we're trying to sort of including, you will see that we're exploring that, more brand ambassadors. We're exploring more ways of reaching the consumer to maintain that growth rate of, 10% plus, 8 to 10% typically in the food, premium food portfolio. And I'm reasonably hopeful that we will be able to maintain that momentum and the margin profile also. Now to the question whether, the staples should we focus less on and not do that. I think missing sales does not make sense because we do make positive margin. We do have a very positive view towards pushing, our staple products which have done very well for us. So I think the effort going forward is going to be that, wherever the opportunity on staple side is, we continue to sort of, build that business. And on the premium end of the portfolio, we continue to focus a lot more and make that better. And we are quite hopeful that both on the sales increase number and 16 to 18% margin, I think will be the steady state. We should objectively keep as an objective, and we should go towards that.
Maybe it will be useful if you separate the food business details on the lines of premium portfolio and the staples portfolio, so that we can see granularity in the business and margins more clearly, Because of inclusion of these staples, the ability to understand the overall food business is somewhat getting confused, I've
got the numbers right now. Actually, I repeated to one of the previous questions. If you wish, I can read that again.
You don't need to repeat the numbers right now. Bits and pieces in joining and rejoining, I picked up. I'm saying going ahead in general, rather than showing food portfolio in its entirety, we can split it into staples part separately and the premium part separately.
We can do that. I think in our commentary, I think what we put on the exchange, we can split that numbers between the staples and the premium end products. Yes, we can do that.
Because there is a better understanding of how each business is moving and how overall margins are behaving. In absence of this separation, on initial glance, it leads to a lot of confusion.
We'll do that. I think that's a good input. We'll definitely work towards it.
On the other hand, I'm a bit surprised why juices and honey have degrown. Maybe anecdotal, but I personally am a consumer of at least 3 juices on a daily basis, and I find them to be remarkably good products. These are really distinguished products in the market because there are not too many competitive standard products available in this category. Given all of that and given our focus and scale there, why these juices businesses would have degrown is something confusing to me.
So Bharat bhai, I'll just sort of put that in a perspective so that I'm more clear in what I said just now. One is that a lot of these juices, we had a huge bump up last year at the time of the acquisition. It is more showing a more steady state growth right now. So that technically it is not degrown in that sense, number one. Number two is that we retain the leadership in the medicated juices. If we ever to look at the longer term run rate, I don't have the numbers specifically for medicated juices of the year before. I can share them with you. So it is just a one-time sort of change that occurred in the business in the medicated juices. But overall, we have not seen any significant decline. Yes, compared to 9 months period annualized basis that we saw a certain sort of lower sales revenue. And on the honey side, we saw some sequence. Again, we had a one-time sort of benefit that we got on account of the in the initial sort of when the business got transferred on the inventory, a lot of aggressive selling which happened. Basis that it happened. These are not areas of any particular alarm. I think we'll get back to the steady state and we'll build up the business. So broad idea being that sequential growth in the revenues of anywhere between 8 to 10% on the premium category food business will continue. The margin profile of 16 to 18% will continue, and that we are pretty confident about that we'll be able to.
Okay. If I'm permitted, 2 more questions since I joined and rejoined again, if I'm permitted. One on the edible oil. I mean, when I look back in 21-22, it was a golden performance period for edible oil, where our margins were robust, growth was robust, growth in the volume still continues to be very healthy. But that was a year when we made almost about 1,300 crore profit in edible oil, which is remarkably large. And the last 2 years, couple of quarters in each year have been really, really terrible, and where it has produced losses. And the other 2 quarters in each year have been kind of below average. And therefore, last 2 years, edible oil performance in profitability terms has been nothing much to talk about. Can we say that slowly but steadily we'll climb back to where we got in 2021-22? Because that was a year where we made about reasonable 5% plus kind of margins and almost about 1,300 crore profit. So maybe it will be a climb and somewhat a measured one. But do we believe that we are out of the hump, out of the trouble in the last 2 years of the edible oil, and we should get back into steady ascent in that business?
But thank you, Bharat bhai. You asked a very important question. I was hoping somebody will ask. That 5 quarters for the industry have been the worst ever in maybe in a 30-year sort of time frame. The second quarter of last year to stretching to the second quarter of this year. So nearly 5 quarters we have seen consistently, barring 1 or 2 exceptions that we got. Typically they have generally been bad. Now coming back to the state of what we've always maintained, that between 2 and 4% margin in the edible oil portfolio, that we feel pretty confident. This year is 1 year of change. So while this year on the overall EBITDA we have made 117 crores, 117 crores. But if I were to split this between palm and oil palm plantation and the edible oil as an overall portfolio, so we made 156 crores on the palm plantation business, lower compared to last year because of the average prices being lower. So broadly, I think we are getting away from all this, and I would be pretty confident that on a 22,000 crores of revenue or thereabout, if we were to do a steady state on the lower band of 2%, we should be about 450 crores. We should add definitely compared to negative 39 crores on the edible oil side, we should be up by 450 crores. If we were to take 3%, it obviously is better. So one sort of with a lot of conviction and with a lot of effort, our target is that this 117 crores should be closer to anywhere between 500 to 600 crores this year. And that is the path we're working towards. Now, why am I saying this? I've seen that the first month of April has gone by. We're seeing the second middle of this month we're seeing. It's been very positive. So I'm reasonably comfortable that we will not go back to perhaps 1,300 crores, which was an outlier, because that clearly those 2 years were very positive for the industry. But between 2 and 4% range, and I'm saying on the lower band, we should add 400 crores. On the mid-size band, we should add 600 crores to the bottom line. And that I feel pretty comfortable with, that the edible oil should be a turnaround story with all the effort that is going on, both on the brand side, on the risk management side, on seeking supply security, the oil palm plantation increase that we are seeing year on year. I think broadly, I feel reasonably comfortable that we should add substantially to the bottom line, to the EBITDA margin in this year.
And one last short question. Thank you, Asthanaji, for all the earlier part. Interest and depreciation in fourth quarter is shot up very sharply.
Yeah. So, can I answer this, sir?
Yes, please.
So basically, interest which you are seeing for this quarter is 115.90 crores. It includes interest, actually apportionment of redeemable preference share, near about 93.65 crores. It includes, that's why it is increased. Depreciation in 23-24, we had made an alignment of life of all the assets, which was not done earlier in the pre-CIRP period. That's why depreciation has been increased by near about 75 crores. That is still depreciation. Going forward, our depreciation for the whole year will be near about 240 to 245 crores.
Okay, good. Thank you very much.
Yeah. And correspondingly, I would like to clarify one more thing. Other income also includes other income which you are just see the quarterly figures. Last quarter it was for 46.59 crores, and this quarter it has been increased to 126.36 crores. This is also includes the treatment as per Ind AS of redeemable preference share to the tune of rupees 78.65 crores.
Okay. Noted. That's very helpful.
Yes. Thank you.
Thank you. The next question is from the line of Jaydev Balaji from Motilal Oswal. Please go ahead.
So one request I have is that I think this should be the last question because we've got some media interaction starting in 5-7 minutes. So if we can put the last question, please.
Yeah.
Am I audible?
You are audible, yes.
Yeah, okay. Thank you, sir. So I just wanted to ask, this question is not related to numbers or anything. Just wanted to ask any new product launches or any integration processes you're thinking about in the future, or any new developments that you want to launch in the near future, that is to say 3 to 5 years, any plans for the growth of the company in terms of new product launches?
So one is that, the big work that is going on, which, we were not able to discuss on this call, is that evaluation of the non-food HPC portfolio of Patanjali Ayurved that we are evaluating right now. And we're hoping that this will, very quickly we should be able to go through the diligence and the numbers. And very soon you will sort of hear from us post our diligence, and once we have got greater clarity. And so that's going to be, if at all that happens, we are going to have a very major addition to both the revenue and the bottom line, in the business. The second is that very clearly from the FMCG perspective, our premiumization drive across verticals, across portfolios will continue at a rapid clip, both on the food side, on the biscuit side, nutraceutical side, as well as on Nutrela side. There are multiple initiatives which are underway. And the last initiative which I wanted to speak about was our oil palm plantation, which while on the P&L, yet you are not seeing a big growth kicker, but in next 2 years' time that, the growth momentum is going to pick up very substantially. And you will see that I think from end of next year, we'll see the planting that has been the growth momentum is picking up. I think we'll get towards a much larger sort of growth path, both in terms of revenue and the profitability.
Got it, sir. Okay, sir. Thank you so much.
Thank you. As that was the last question for the day, I now hand the conference over to Mr. Sanjeev Asthana for closing comments.
So thank you very much, and for all the wonderful questions and patiently listening to us. With this, I conclude the call. Thanks for all the patience. If you have any further queries, please contact SGA, our investor relations advisor. And everyone, please have a good day and wish you all the best. Thank you so much.
Thank you. Thank you very much.
Thank you. On behalf of Patanjali Foods Limited, we conclude this conference. Thank you for joining us. You may now disconnect your lines. Thank you.